What is finance? Finance is the study or science of managing large sums of money. It is a huge umbrella used to reference any activities that have to do with investing, leveraging, capital, credit, markets, banking, and credit. Finance is also used to describe and direct the process of acquiring the funds. This is where the phrase finance a business, car, house, etc. comes from. Most basic financial concepts, where we will be discussing in more depth throughout this chapter, are derived from macroeconomic and microeconomic theories. The value of money is one of the most remarkable theories. This one suggests that the value of the dollar today is higher than it will be in the future. The study of finance can be divided into three categories: personal, corporate, and government, or public finance. The financial services sector drives a country's economy. This is the sector where businesses and customers interact to acquire financial goods. It acts as an intermediate where savers, consumers, offer funds to financial services, banks, stock brokerages, insurance companies, and other institutions and instruments, so they can lend them to borrowers, businesses, households, or the government. Subcategories of finance: households, individuals and families, businesses, and governments can't operate if they don't have enough funding. Corporate finance. Corporate finance accounts for the financial activities that any business, corporation, or private institute conducts. These financial activities are associated with the operation and running of a business. The company typically has a team or an entire department responsible for overseeing and managing those financial activities. For instance, a situation relating to corporate finance would be a business determining if it should raise the needed bonds by offering stocks to the public or issuing bonds. Corporations may seek out the guidance of investment banks to help them make these financial decisions and aid them in the marketing activities related to the securities. Another example would be the capital that the startups need to operate their business. In that case, they can get the needed capital via venture capitalists or angel investors. In exchange, startups offer them a decided percentage of ownership. If this business wishes to grow and become a public corporation, it will issue shares on the stock exchange market. This can be done through an IPO, or initial public offering, allowing them to raise capital. While it can be very challenging, especially if the cost of running the startup is high, it may try to budget and save its capital. It will identify areas of the business that need financing, prioritize them, and decide which ones can be put off for later. This will allow those in charge to work towards priorities for the company's growth first, then tackle the next steps. Public finance. Public or government finance refers to a government's budgeting, spending, debt insurance, and tax policies. These policies influence the government's ability and the methods they use so it can pay for all the public services provided for its citizens. Public finance falls under the macroeconomic concept of fiscal policy, which refers to the impact tax policies and government spending have on economic activities like employment, the aggregate or overall demand for goods and services, inflation, economic growth, and inflation. A government's financial decisions and activities help it prevent a market failure. The state does so by managing the allocation of resources, overseeing the distribution of income, and maintaining general economic stability. Most of a government's funding comes from its tax policies. The state may often resort to borrowing from the public via banks or insurance companies. Governments can also seek funding from other countries. Besides managing the flow of money in regular daily operations, the state also oversees other fiscal and social activities and services. Since citizens, particularly those who are obliged to pay taxes, participate in fulfilling a government's funding needs, the state is expected to offer adequate social programs in return. It is also expected to maintain economic stability to reinforce trust and eliminate uncertainty among its people. Taxpayers need a guarantee that their money is safe and that they can save for the future. Personal finance. You're probably most concerned with personal finance if you're reading this book. When households participate in financial planning activities, they consider their current financial standing. This allows them to develop strategies that help them meet their future needs within their financial limitations. Personal finance refers to an individual's or a household's current financial activities and standing. These plans are highly dependent on a person's income, the standard of living, wants, needs, and goals. For instance, people need to take into account their retirement plans. To properly prepare for retirement, they need to make sure that they're saving up and investing enough money during their working years to finance their long-term plans. Personal finance comprises a wide array of activities, including investing in financial goods, such as insurance, credit cards, and mortgages. Banking also falls under the category of personal finance because households use Venmo, PayPal, and other mobile or e-payment services, savings accounts, and checking accounts. What are financial services? As mentioned above, financial services are the processes or intermediaries via which households and companies obtain financial goods. To simplify things, let's take a look at the financial service that a payment system provides. This service facilitates transactions between the person who pays and the entity that receives the funds. The function of this service is to accept and receive transfers between those parties and comprises accounts settled through debit cards, checks, credit cards, and electronic funds transfers. The financial services industry makes up one of the vital aspects of the economy. Without financial services, the economy wouldn't be able to operate. This sector drives liquidity and the free flow of capital in a nation's market. Finance companies, lenders, insurance companies, real estate brokers, investment houses, accounting services, and banks are just a few financial institutions that make up this sector. This is an essential sector because it aids in the maintenance of a nation's economy. When both the economy and this sector are strong, the trust, assurance, and certainty of consumers or households rise and their purchasing power. Similarly, when this industry declines, the economy declines, dragging the nation into a state of economic recession. It must be noted that financial goods and financial services are not the same. Financial services are not owned and can't be separated from their provider. For instance, receiving advice on your investments from a professional, having someone manage your investments, or receiving any other services provided by a financial advisor are all examples of financial services. On the other hand, financial products are things that you can own, such as insurance policies, stocks and bonds, and mortgages. What are financial activities? Financial activities are any process, transactions, and strategies that companies, households, and governments take so they can take steps towards achieving their economic goals. These activities typically revolve around the flow of money, whether they are inflow transactions, receiving money, or outflows, spending. Purchasing and selling assets or products, offering and receiving loans, keeping accounts, and issuing stocks are all examples of financial activities. Examples of a company's financial activities include repaying debts and offering shares. Households and governments participate in financial transactions, activities, when taxes are levied or loans are taken out. Economic concepts you need to know. The study of finance is driven by and derived from economics. While finance assesses several components of the financial system, such as credit, investment, cash, and banking, economics is the study of the consumption, distribution, and production of goods and services in a market. Its main concern is the behavior and the financial interaction between the players in any economy: households, governments, and businesses. There are two subcategories of economics: macroeconomics and microeconomics. Macroeconomics focuses on the performance of an economy as a whole, while microeconomics is concerned with single factors of the economy and the impact of their individual decisions. Financial economics refers to analyzing markets and assessing how their resources are used and distributions. Economic theories evaluate how risks, opportunity costs, time, and certain information can affect an entity's financial decision. We know what you're probably thinking. I am here to learn how to budget for my household's needs, save for my retirement plan, or make better investment decisions. How will understanding economic theories help me? Well, as dramatic as this may sound, the essence of economics influences every aspect of our lives. The proof here is that fundamentally, economics aims to explain the reasons behind our financial choices. Understanding the reasons behind your financial decisions is the key to making better spending choices. The following concept can help you understand why you make the financial choices you do. Scarcity. Scarcity is a concept that everyone understands because we've all experienced its impact in one way or another. As you can guess from the term, scarcity references one of the most common and basic economic problems to exist. That is, having fewer or limited resources in comparison to the world's unlimited wants. No matter how many resources there will never be enough to meet the world's infinite desires. This is why we are obliged to allocate our resources as efficiently as possible. Making smart financial and budgeting decisions would allow us to ensure that our highest priorities are always met. For instance, let's say there is only so much land that we can plant every year. While some people want apples, others want cucumbers. Only a limited amount of either good can be produced because of the scarcity of agricultural land. So, how do those in charge determine how much land to allocate to plant apples and cucumbers? The only way to decide is by examining the concept of supply and demand, the drivers of a market system. Supply and demand. Supply and demand are what drive a market system. Let's take the example above. When many people are willing to buy apples at a given price, the demand for apples is relatively high. This is why apple sellers are prompted to charge more for them. Charging a higher price allows them to make more profit and meet the rising demand. Farmers who plant the apples will also charge the sellers more for the fruit and will be compelled to allocate more land to planting apples than cucumbers. In most cases, other people will want to start selling apples too, or the goods in the high demand, so they can also profit. As a result, there will be plenty of apples in the market after a couple of production cycles. People then will expect to pay a lower price for the apples because they're so abundant now. Additionally, supply is a lot higher than demand at that point, production surplus, so fewer apples will be produced. The supply of apples decreases, and so does the price. Even though the concept of supply and demand is very simplified in this example, you can still understand how supply and demand work together to determine the price of goods. You can also see why many popular products are almost half the price after a year or so. Costs and benefits. Economics is based on a very important theory, the concept of rational choice and expectations. This theory plays a huge role in how we make our financial decisions, as it's related to how we measure a product or service's cost against its benefits. In economics, rational behavior refers to an individual's effort to maximize the ratio of costs to benefits when they make any financial decision. For example, landowners will hire more workers to plant or harvest apples if there's high demand. However, this would work only in the case if the selling price of apples, along with the number of apples being sold, were worth the additional costs incurred by the landowner. Higher wages, more advanced agricultural technology, and perhaps land expansions are examples of these costs. Similarly, customers will search for the highest quality of apples they can afford to buy: fresh, pesticide-free, firm, lack discolorations, etc., but not necessarily pay for organic apples sold at specialty grocers. This concept is not limited to financial decisions, which shows how far the study of economics is involved in our lives. For instance, you perform a cost-benefit analysis whenever you prioritize a certain task over another. Because it's important that we act rationally and maximize the ratio of costs to benefits, it's important to realize whenever we aren't ratios. Daily advertisements and marketing tactics can trick us into overestimating the benefits of purchasing a certain good or service. Incentives. As humans, we are all inclined to perform better when offered a reward or an incentive. On an economic level, the interaction of supply and demand in the market can act as an incentive for producers to offer the goods that households want and for households to preserve scarce resources. As you know by now, prices rise when demand increases, so suppliers have the incentive to supply more of that commodity because they can now make more profits. However, this increase in supply and demand prompts scarcity of raw material, and so the cost to produce that good rises, causing suppliers to supply less. The price of the goods rises even more, and so consumers will now have an incentive to cut back on their consumption. Consumers will never pay more for a product than its esteemed value of it. In the example of an apple seller, the landowner wants to increase the production of apples. One way to do that would be offering an incentive, or a raise in wages, to the farmers who harvest the most apples in a given time frame. In a couple of weeks, the number of apples produced rises. The problem here is that the landowner offered the incentive for the number of apples produced rather than their quality. The store owner that the landowner supplies called to complain about the quality of the apples he received. Because the higher wages were offered for the number of apples harvested, farmers found it more efficient to pick the apples slightly earlier than they were supposed to. This is why people should be careful and precise when offering incentives. They should align with the individual's or business's goals. What is financial literacy and why is it important? Financial literacy refers to an individual's knowledge regarding managing their credit, finances, and debt. All responsible and rational decisions are based on your level of financial literacy. These decisions include, but aren't limited to, setting up a budget, knowing how to use different financial tools, and when to refer to financial institutions and professionals, and paying off debt. In short, financial literacy has a huge influence on an individual's ability to make ends meet, cover their priorities and basic needs, finance their kids' education, purchase a home, and plan out their retirement. Many people, even those who live in advanced economies, struggle with financial illiteracy. There are people across the world who don't grasp basic financial concepts, which is why they have trouble maintaining a certain standard of living. Generally speaking, the higher the lack of financial literacy in an economy, the poorer the overall nation is. However, it's still worth noting that even though income levels and the quality of education influence a person's level of financial literacy, it was found that many high-income and educated households maintain the same level of financial ignorance as the less fortunate. Thinking about financial issues and matters can be incredibly stress-inducing and anxiety-triggering, which can be very troublesome for many people. As you can probably already tell, financial literacy is vital because it allows people to make informed decisions when it comes to handling their finances. Additionally, the number of financial burdens and responsibilities that fall on an individual increases over time. At the most basic level, past employers managed their employees' retirement accounts. Nowadays, however, self-directed retirement accounts shift this responsibility over to employees. The number of financial options and products available has also increased greatly. Credit can also be accessed more easily. This means that the number of choices that an individual has to make is greater. In this chapter, we covered what finance as a study is and the main economic factors that influence our financial decisions. You better understand how the interplay of supply and demand impacts price levels, a producer's willingness to supply, and a consumer's willingness to produce. You also understand the importance of financial literacy, which is something that this book is guaranteed to help you grow.